Hi, your kid may have an account, a bank account or an investment account, and it's earning returns.
Mm-hmm.
And you're thinking, that's great, they're going to be taxed at a lower tax bracket. That may not be true. They may be subject to the kiddie tax. Let's talk about what it is and how it may affect you and your family. Hi, I'm Dave Lopez.
And I'm Chase Lopez, and we're investment advisor representatives with ILG Financial. This is another episode of Retire Your Way with ILG Financial, where we talk all things retirement. Now, Dave, before we jump in, just want to remind everyone, go ahead and hit that like button and hit that subscribe button so that you can be alerted for any future videos.
Yeah.
So the kiddie tax, right? We're going to, as Dave mentioned, we'll talk about what it is and how it could potentially affect you. Why don't we just jump right in? What is the kiddie tax?
Yeah, so let's talk about the 10,000-foot view of the kiddie tax.
Mm-hmm.
It was created, the goal of it is to stop parents from, for lack of a better term, Chase, shielding their income. So imagine your parents are you're in a higher tax rate.
Right.
So you have some earnings and you don't want to pay the higher tax rate. So you think, what if I just put this stuff in my kid's name? Since they don't have any other income, they'll pay a lower tax. And in theory, that's true.
Right.
The kiddie tax is designed to keep you from doing that.
Right.
Right. So it applies, that's what it's for.
Yep.
It only applies, and this is important, to what's called passive or unearned income.
Yep.
So meaning it doesn't apply to a job, like if they're working part-time or doing a job. Only interest, dividends on an account, gains if they sell something like capital gains from a stock. And if it only applies if they earn over a certain amount.
Mm-hmm.
If it's a real small amount, the kiddie tax doesn't apply. We'll address that today.
Yep.
Okay?
So going back to your point about why, right, is really because for most people, your parents or the parent is in a higher tax bracket than their child would be.
That's right.
Which makes sense. They have a job, they have a salary, all that stuff. So without the kiddie tax, the parent could, in theory, move the assets into the kids' names to pay a lower tax, right? So that's basically what we're eliminating there.
Yeah.
So how it works is the first $1,350 of unearned income, like you mentioned, is not subject to the kiddie tax. So if your child has $1,350 of either interest or dividends from a stock portfolio, that will not be subject to the kiddie tax for them. If it's between $1,350 and $2,700 or $2,700, it will be taxed at your child's rate, which most likely is zero, right? If they're not working or anything, right? Most likely,
zero.
It probably will be zero. Anything above that $2,700 number of unearned income will be taxed at the parent's income tax rate. So that's how they eliminate the parents trying to move money into their kids' accounts.
Yeah, so let me just give you an example, if you don't mind. So let's say that Chase is 17 years old, right? And his dad wants to put an account in his name, and Chase makes $5,000 in dividends. And that's all that the income that he has. Well, based on what Chase just said, the first $1,350 is tax-free, right? The next, if you do the math on that, the next $1,350 is taxed at Chase's rate. And like you just said, Chase, if that's all your income, just doing the math on the taxes, your taxes on that will be zero too, right? So in this case, the first $2,700 is tax-free, but the next dollar of dividends, of that $5,000 dividends, which would be the next $2,300, even though on his tax return, it still would have been zero tax rate.
Right.
It's taxed at whatever the rate your parents' tax rate is, which might be 22, 24, or 32%.
Yep. So who files the return, right? So if you are in that scenario, who files the return? So if your child only has unearned income, you can choose to file it on your return or on their return, right? For simplicity, you can just have it on your own return if you want. Now, if your child has a job, right, and they're already filing a tax return because they have to, right? They had a job or whatever the case may be, then you'll probably end up having to file two tax returns. Your child will have to file a tax return, and then you will as well. And then they'll do the math on how much kiddie tax will be due for the child.
Yep. So does the kiddie tax apply to when we talk about kids? would be your children under 18 years old.
Yep.
Right. But if they're in college, it's under 24 years and college and still listed as dependent on your tax return.
Yep.
You get to do that. It doesn't apply to wages they earn. So if they're working at college, a part-time job, it doesn't apply to those. That's just taxed on their tax. They're going to do their own tax return, and it's going to be taxed on their return. Also interesting, just to make clear, it has nothing to do with the size of the account that the child has. It has to do with these interest or the dividends or the capital gains that are being spit off.
Right.
The example I gave you with the Chase earning $5,000 if he was a dependent, that account could be $1 million account.
Right.
If it was only spitting off $5,000, that's all we're looking at. So it has nothing to do with the size of the account.
With that said, right, who doesn't need to worry, right? This isn't,
that's a good,
so this applies to less people than you probably think, right? So it usually only kicks in for folks or for families that have large investment accounts, right?
Yes.
So you have a large investment account, your child has a large investment account for whatever the reason may be. If you're in a high income household, so if you're making, with you and your two parents, right? You and your wife or your husband are making a lot of money, right? That's when this will typically kick in. Or when kids get big distributions from trust. Let's say there's some sort of trust fund that is paying them money. That's a big one where this kiddie tax can, kind of kick in. Unless you're very wealthy or you've had a very lucky run with investments, this probably will not apply to you and your children.
Yeah, a lot of you will know, right? Because you would have physically moved the money a lot of times into the child's name.
Right.
So then you'll know. If you're not sure, if there's any account in your child's name, get with your tax professional or your financial professional or both and ask them.
Yep.
Right. You want another set of eyes looking at it. That's the advantage to using a financial professional. It's just another set of eyes coaching you. We highly encourage it. And they can walk you through it. And you don't know what you don't know, so have someone else take a look.
Don't forget, hit that like and subscribe button so you can see our future videos, and we'll talk to you next time.
Talk to you next time.
Hi, Dave Lopez here. I want to thank you for watching our ILG Financial video series, Retire Your Way with ILG Financial. Just wanted to remind you, in addition to our YouTube video series, we also offer podcasts, 30-minute podcasts on different topics. You can check them out through our YouTube channel. You can also look at them through our website or any of the below listed platforms. Talk to you soon.